Welcome back to Investing Talk Podcast.
Today we're looking at USO.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Right, so we have a lot of ground to cover today.
We really do. Because let's set the stage here for a second. We are currently navigating a market environment that just feels incredibly fragile.
Yeah, fragile is the word.
It's defined almost entirely by these sudden global geopolitical shocks. You wake up, pour your coffee, read the news, and see international headlines that make your stomach drop just a little bit.
Absolutely.
And the immediate pragmatic question for your portfolio when you see that is, well, how does global tension translate into investable momentum?
Exactly, which is why we're not looking at a standard equity today.
Right. USO is not building consumer electronics. It's not licensing enterprise software. You really need to think of this asset as a direct, highly liquid pipeline to the price of light, sweet crude oil.
And to give you an immediate quantitative sense of why this matters for your strategy right this second, USO is currently up 25.31% over just the last 3 months.
Wow. Over 25%.
Yeah, in just 3 months. To put that into perspective, that level of violent upward momentum means it's outperforming 93% of everything else in its category.
That's a massive move.
It is. And what's absolutely fascinating here is that this isn't just a random commodity spike. It's not a seasonal inventory adjustment. We are witnessing a massive psychological risk-off market shift.
People are scared.
They are. Capital is actively seeking shelter right now, and this specific asset is acting as one of the primary global safe havens.
And that's exactly why we need to understand what's under the hood. Because buying into a safe haven without knowing how it actually functions, that's how you get burned. Let's open up the fundamentals.
Let's do it.
Now, usually I'm the one grilling you on revenue growth, profit margins, forward guidance, quarterly earnings calls. But looking at USO, there is no revenue in any traditional corporate sense. It's not pulling barrels out of the Permian Basin, is it?
It's not. And that is easily the most common misconception for investors newly entering the commodities space.
They think they're buying an oil company.
Right. When you hit the buy button on USO, you are not buying an energy exploration company. You aren't buying the drilling equipment, the pipelines, or the refineries.
You're buying paper.
Exactly. You are buying an exchange-traded fund structured specifically to track the daily price movements of near-month WTI crude oil.
And just for a bit of context for anyone unfamiliar, WTI stands for West Texas Intermediate, which is the underlying benchmark for U.S. oil.
Right. And specifically, this fund tracks the crude that is scheduled to be delivered to a very real, highly strategic physical location, which is Cushing, Oklahoma.
Right, Cushing. If you've never looked it up, fly over Cushing on Google Earth sometime. It looks like a massive, sprawling grid of alien landing pads.
It really does.
It's just endless white storage tanks holding millions of barrels of crude. It's the primary intersection of the North American pipeline system. But here's my skeptical question for you. USO doesn't actually own those massive white storage tanks, right?
No, they don't own the physical infrastructure.
So how do they track the price without taking physical delivery of millions of barrels?
They do it entirely through the financial markets. They use futures contracts traded on the NYMEX exchange, along with certain over-the-counter swap agreements, to perfectly mimic the price of the physical commodity.
Okay, futures contracts.
Yeah, a futures contract is simply a standardized legal agreement to buy or sell that oil at a predetermined price at a specific time in the future.
Okay, so if they don't own the physical oil and they're just trading paper contracts back and forth on the exchange, what does the financial health of the fund actually look like?
It's actually very solid.
Because if we're talking about a multi-million-dollar paper trail, I have to ask, is this just a highly leveraged house of cards waiting to collapse?
Not at all. The financial plumbing here is incredibly robust. To answer your question with the hard data, you're looking at a fund with $1.14 billion in assets under management.
Over $1 billion?
Yes, backed by 13.22 million shares outstanding. And to address the risk factor you mentioned, there's absolutely zero traditional corporate debt.
Zero.
Zero. Because of how the fund is structured by regulatory design, it is fully collateralized.
Fully collateralized by what exactly? It's not physical oil?
Right. It's collateralized by cash, cash equivalents, and highly secure short-term U.S. government obligations. We're talking specifically about U.S. Treasuries with maturities of 2 years or less.
Okay, that makes sense.
So the underlying foundation of the fund is about as stable as it gets. It exists purely to provide the necessary liquidity to execute those futures rolls and swap agreements seamlessly.
But hold on a second.
hmm
Constantly rolling paper contracts every single month, executing swaps, and managing over $1 billion in Treasury collateral. That sounds incredibly labor-intensive.
It is a complex operation.
Are investors just getting eaten alive by management fees to keep this whole thing running?
You'd think so, given the complexity of the derivatives market, but the expense ratio is sitting at just 0.60%.
Wow. Only 0.60. For you listening, the expense ratio is just the annual fee the fund charges to keep the lights on and manage the portfolio. But at 0.60%, that is exceptionally low for a fund actively managing complex commodity contracts.
It really is. It minimizes the drag on your returns in a market that's famous for wild volatility.
But if the barrier to entry is just managing futures contracts efficiently, why hasn't a massive Wall Street competitor just launched a copycat fund and stolen all their market share?
That comes down to their competitive moat, which is
Yeah.
built on pioneer status.
Oh.
USO was launched way back in April of 2006.
Wow, so they've been around a while.
Yeah, it was the original oil ETF.
Mhm.
Over nearly 2 decades, it has built a structural liquidity advantage that smaller competitors simply cannot touch.
Okay, well, let's break down exactly why they can't touch it. Because it really comes down to the mechanics of institutional money. When massive institutional players, think giant pension funds or hedge funds, when they need to create a basket of 100,000 shares of USO, the transaction fee is only $350.
Which is nothing at that scale.
It is absurdly, almost comically cheap. It effectively locks in institutional flow. If you're managing billions and you need immediate liquid oil exposure, you go to the cheapest entry point with the tightest spreads.
Precisely. And this heavily deters rival funds like UCO, which uses complex leverage, or BNO, which tracks a completely different benchmark, Brent crude. USO is the undisputed heavyweight champion of WTI crude exposure.
Which naturally leads us to how this structural fundamental dominance is translating into current market behavior.
Exactly.
So structurally, this fund is a fortress. But does that fundamental strength actually translate to the tape? Because right now, the price action looks violent. Go over to the charts. What are we seeing under the hood of this momentum?
We are looking at a textbook, highly aggressive, bullish breakout. Just recently, we saw USO gap up significantly overnight.
A huge gap up.
Yeah, it closed one session at 79.77 and violently gapped up to open the next session at 82.00. Right now, it's trading in a tight consolidation range right around 81.95.
And a gap up in a major commodity structure like this, I mean, that isn't just retail traders hitting the buy button on their phones because they saw a news alert.
No, absolutely not.
That kind of overnight price dislocation implies aggressive, urgent buying. Buyers didn't want to wait for the market to settle after the opening bell. They needed exposure immediately, regardless of the premium.
Precisely. And it's knocking loudly on the door of its 52-week high, which currently sits at 83.57.
So close.
When an asset pushes up against a major resistance level like a 52-week high after a violent gap up, that is pure momentum, and the volume absolutely corroborates the price action.
What are the volume numbers looking like?
We recently saw 12.16 million shares traded in a single session. That is heavy, concentrated institutional accumulation. Smart money is flowing aggressively into this structure.
And this brings us to a crucial data point that dictates exactly how you should think about utilizing this asset in your own portfolio strategy. I'm looking at the beta here.
Yes, USO currently has a beta of 0.21.
Let's talk about the implications of that for a second. At a beta of 0.21, USO is basically living on its own planet.
It really is.
Tech stocks could crater, banks could stumble, the Federal Reserve could announce a surprise rate hike, and USO fundamentally won't care. It is almost completely uncoupled from standard equities. It moves based on physical oil supply shocks and nothing else. It is a pure, unadulterated hedge.
That's a vital distinction for your portfolio construction. You aren't buying this because you think the broader economy is doing great or because consumer spending is up. You're buying it because you recognize instability and you need a shock absorber.
Which brings us to exactly what those shocks look like. Let's shift over to market sentiment. We can't talk about a 25% momentum surge in oil without addressing the geopolitical storm driving this asset right now.
We are seeing a profound shift in quantitative sentiment, driven by incredibly intense geopolitical headlines.
And to be clear, We are analyzing these events strictly through the lens of market mechanics, capital flow, and supply chains. We're impartially reporting on the environment without taking a stance on the politics themselves.
Of course, but the headlines are severe. We are looking at recent, highly impactful news cycles dominated by phrases like the fallout of US-Iran Round 2 and discussions surrounding Operation Epic Fury.
Right.
We're even seeing direct, explicit calls from mainstream financial media outlets telling retail and institutional investors alike to buy oil ETFs.
You can see the psychological shift playing out in real-time order flows. Capital is inherently cowardly. It hates uncertainty. When rhetoric escalates or shipping lanes get threatened, money aggressively flees risky assets.
It looks for safety.
Exactly. We are seeing a clear, measurable rotation out of high beta technology equities and highly speculative assets like crypto. That capital isn't just sitting in cash, it's pouring directly into historic safe havens. Gold, aerospace, and defense sectors, and physical oil.
And the speculative catalysts driving that rotation are immediate macro threats. Specifically, the potential closure of the Strait of Hormuz, alongside reports of UAE intercepts.
Those are major flashpoints.
They are. And this raises an important question regarding market psychology. Why does a regional conflict halfway across the world cause a US-based oil ETF to gap up overnight?
Because the Strait of Hormuz is the global economy's jugular vein. It is a geographically narrow choke point, but a massive percentage of the world's daily oil consumption passes through it.
Right.
If there is even a credible rumor of a physical supply bottleneck, if massive oil tankers cannot safely transit that strait, the supply of available crude on the global market plummets.
Instantaneous.
Global demand hasn't changed, right? People still need to drive to work, they still need to fly airplanes, but the supply is suddenly choked off. That instantly translates to upward price action for WTI crude, which instantly translates to USO's share price rising. The market is a forward-looking mechanism. It prices in the worst-case scenario before a single ship is actually blocked.
Precisely. The equity market hates uncertainty, but commodities trade on physical realities. If the supply is threatened, the price of the contracts USO holds goes up. The sentiment isn't just blind fear, it's a cold, calculated preparation for a global supply deficit.
It sounds almost too perfectly set up right now, but we have to look at the downside. Let's break down the bear case. As the skeptic here, I have to ask the toughest question in the room. What happens to this momentum if peace breaks out tomorrow?
It's the most critical risk factor on the board. This entire 25% rally over the last 3 months is heavily padded by what we call a geopolitical risk premium.
Sure.
If there is a rapid, unexpected diplomatic resolution, say a sudden de-escalation between the US and Iran, that risk premium will evaporate overnight. The fear of a supply shock disappears, and the price of crude oil would likely plummet straight back down to its fundamental demand baseline.
And USO would follow it straight down. Gap down and all.
Exactly.
That's the headline risk, which is obvious. But there's a structural risk to this fund that is arguably far more dangerous to the average retail investor because it's entirely invisible if you don't read the prospectus.
Yes.
You mentioned the futures contracts earlier. I know there's a trap there for people who don't know what they're holding.
I'm so glad you brought this up. If you take absolutely nothing else away from this analysis, you must understand a concept called roll decay and a market condition called contango.
Okay, let's explain this mechanism.
Yeah.
As we established, USO does not hold physical oil. It holds paper contracts that expire every single month. When a contract is about to expire, USO can't just take delivery of the oil in Cushing. They don't have those weight storage tanks. So they're forced to sell that expiring front-month contract and buy the contract for the following month to maintain their exposure.
Exactly. Now, in a normal, peaceful, well-supplied market, the contract for next month is usually slightly more expensive than the contract for this month.
Why is that?
The reason is simple. Storing physical oil costs money. You have to pay for the facility, the insurance, the security. That future price reflects those carrying costs. This upward-sloping price curve is called contango.
I like to think of it using a real-world analogy. Imagine buying highly sought-after concert tickets for next month. But you don't actually want to go to the concert, you just want to hold the tickets as an investment.
That's a good way to picture it.
As the concert gets closer, you have to sell your ticket and buy one for the following month to stay invested. But the ticket brokers know you are forced to buy, so they charge you a slight premium every single time you swap. You are constantly forced to sell cheaper and buy more expensive. You bleed capital. It's a leaky bucket. That is roll decay.
That is a perfect analogy, and the quantitative data on this is incredibly sobering. Because of this constant structural bleed in normal, peaceful markets, the historical average annual return for USO is a staggering negative 9.0%.
Wait, -9% a year.
Yes.
Let me repeat that for you listening so it really sinks in. Historically, on average, this asset loses over 9% a year. That proves beyond a shadow of a doubt that USO is strictly a tactical tool.
Strictly tactical.
This is absolutely not a buy and hold asset that you casually tuck away in your retirement account for 10 years alongside your index funds.
Yeah.
If you do that, the roll decay will quietly eat your capital alive.
Context is everything. Right now, because of the acute supply fears we discussed, the market is not in contango. It's frequently flashing into backwardation, where near-term panic pushes current prices higher than future prices, which can actually benefit the roll yield temporarily.
But that's temporary.
Right. You must remember that the moment the geopolitical landscape normalizes, that negative 9.10% historical gravity kicks right back in. You have to know exactly what game you are playing.
Let's bring it all together for the final verdict. We've looked at the massive liquidity moat, the violent 25% momentum surge, the geopolitical powder keg surrounding the Strait of Hormuz, and the very real structural dangers of contango and roll decay.
Based on all the quantitative scoring, the momentum indicators, and the current macro landscape, the final verdict for USO right now is a bullish score of 8 out of 10.
An 8 out of 10. That is a very high conviction score, given the structural risks.
Break down the actual investment thesis for the listener. Why an 8? The multi-month thesis here is that these strong geopolitical tailwinds, the genuine physical threats to the global oil supply chain, currently overpower the ETF's structural drags. The fear of what is happening in the Middle East is acting as a massive upward force that completely negates the roll decay for the time being.
And what is the exact target horizon for a trade like this? Because as we thoroughly established, you do not hold this forever.
This is defined as a swing trade. The target horizon is strictly 1 to 3 months. The goal here is to capture the asymmetric upside of this risk-off momentum before one of two things happens. Either the conflict resolves diplomatically and the risk premium vanishes, or OPEC Plus reacts to the high prices by flooding the market with their spare capacity to stabilize things.
So it's a very defined window.
You get in, you capture the geopolitical fear premium, and you get out before the fundamental gravity of the oil market reasserts itself.
That makes perfect sense. It's a precision instrument designed for a very specific moment in time.
It is. And analyzing this asset actually leaves us with a fascinating, broader question to consider for the future.
Oh, what's that?
Well, we spent this entire time talking about how vulnerable the global economy is to physical oil choke points like the Strait of Hormuz. But think about the massive trillions of dollars pushed toward green energy infrastructure and electric vehicles over the next decade.
Right, the whole energy transition.
If we successfully electrify the global fleet, do these geopolitical choke points completely lose their power? In 2035, will an oil ETF still violently gap up overnight on Middle East tensions? Or will the market barely register it because our dependency has shifted to entirely different supply chains? Will we be tracking lithium futures with the same intensity we track WTI today?
That is a fascinating question and definitely something to mull over as you look at the long-term thematic shifts in your own portfolio. A vital concept to explore as we continue to navigate these markets. As usual, thank you for joining us on this analysis. Subscribe, like, and comment to support the podcast.